Welcome to the Deep Dive. Today we're digging into ADTRAN Holdings' second quarter 2025 financials that came out August 5th.
Yeah, and it's a really interesting one. Kind of a paradox, actually.
Exactly. That's what we want to unpack. You've got this impressive revenue growth, really strong cash generation too.
Right.
But then earnings per share, well, it was flat. And the market didn't exactly love that.
No, the reaction was definitely cautious. So the big question is this, a growth story hitting a speed bump on profitability, or is the market maybe missing something bigger?
That's our mission today, to really understand what's driving ADTRAN, the good and the less good, and see if maybe there's more to it than that initial market reaction suggests.
It's certainly a quarter that presented a fascinating tension. You've got that robust top line, like you said, signals strong demand. They're getting into the market. But then the bottom line, tells a different story. Makes investors wonder, how quickly can that growth actually turn into solid, sustainable profit?
That's the core question, absolutely. So let's lay out the key numbers first, the ones that created this sort of mixed signal.
Okay.
ADTRAN reported Q2 2025 revenue of $265.1 million.
Which, for context, is pretty healthy growth. That's up 17% year over year.
And 7% up from just the previous quarter. And what's really notable here, they actually beat the street estimates. The consensus was around $260.6 million.
So a clear beat on revenue, no question there.
But?
Yeah, here comes the but. For people tracking profitability, the non-GAAP EPS, earnings per share, it came in at $0 flat.
Right, 0.00, which fell short of what analysts expected by about 2 cents, and it was down from 3 cents in Q1.
And if you look at the GAAP number, the standard accounting measure, it was actually a loss of 24 cents per share, diluted.
So maybe quickly explain non-GAAP versus GAAP again for listeners.
Sure. So non-GAAP earnings, they often strip out things like one-time charges, acquisition costs, stock compensation, stuff like that. It's meant to give a, let's say, cleaner view of the core operational performance. So even on that adjusted basis, the earnings or lack thereof were a bit concerning. And that's definitely where the market's focus went straight away.
That makes sense. So top line beat, bottom line miss, even on that adjusted basis.
Yeah.
Now, what about margins?
Well, the non-GAAP gross margin was 41.4%. Non-GAAP operating margin came in at 3.0%.
Which are, okay numbers, but not exactly setting the world on fire in terms of high profitability right now.
No, they're a bit thin. But on the flip side, the really positive story was cash generation. That really stood out.
Yeah, tell us about that.
Operating cash flow was strong at $32.2 million. And non-GAAP free cash flow, which is basically cash from operations minus capital expenditures, was $18.3 million.
And importantly, their cash balance actually went up, right?
It did. Cash and equivalents increased sequentially quarter over quarter by $5.0 million. They ended the quarter with $106.3 million in cash.
So this is where, like you said, the plot thickens for investors. How do you weigh that? Strong revenue, good cash flow coming in.
Right.
Against basically flat earnings and these thinner margins.
Exactly. And the market's reaction, being cautious, tells you that, look, while revenue growth is great, investors really want to see that clear path to sustained earnings power. Especially now, efficiency is kind of the name of the game.
That's a really good point. Okay, so let's move beyond that snapshot now and dig into the drivers. What was behind these numbers, especially management's view on things?
Yeah, let's get into the specifics. What actually powered that impressive revenue growth?
Where did it come from?
Well, what's really interesting is how broad-based it was. It wasn't just one area. All three of their main revenue categories delivered growth, both sequentially and year over year.
And those are?
Optical networking solutions, access and aggregation, and subscriber solutions. So the whole portfolio seems to be contributing.
Okay, let's take those one by one. Optical.
Optical networking saw really impressive growth, 22% year over year and 15% just from Q1. And this demand wasn't just U.S. focused. It was U.S. and non-U.S. regions, particularly strong demand from U.S. service providers.
And they're adding new customers too.
Yeah, that's key. They picked up 18 new optical customers. And they mentioned cross-selling wins, which suggests that the merger with ADVA is starting to create those synergies they talked about, getting fiber access customers to buy optical transport and vice versa.
Okay, that makes sense. What about access and aggregation? That sounds like the sort of plumbing for broadband.
Pretty much, yeah. Things like the equipment in the central office or street cabinets connecting homes to the fiber network. And that segment grew an incredible 30% year over year.
Wow, 30%.
Yeah, really strong, driven by big European service providers and also the smaller mid-sized guys in the US. Their SDX portfolio, that's their main fiber access platform, and the Mosaic cloud software that manages it, they continue to drive success there.
They mentioned a number for homes passed.
They did. Over 10 million homes passed using just one specific product, the SDX 6330. That's a huge footprint. Shows they're really embedded in these next-gen broadband rollouts.
Okay, so strong optical, very strong access.
Yeah.
What about the third leg? Subscriber solutions. That's like the gear in the home.
Exactly. Routers, ONTs, that kind of thing. That grew too. 4% sequentially and 2% year over year. Not quite as explosive, but still growing.
And within that?
Residential solutions did particularly well, up 18% quarter over quarter and 25% year over year. So people are definitely upgrading their home setups. Plus, they added 20 new service provider and government customers in this segment.
Diversifying the customer base. And geographically, you mentioned U.S. and non-U.S.
Yeah, non-U.S. revenue was actually the majority, 55% of the total.
Yeah.
U.S. revenue was 45%. So they have a good global balance.
Okay, so the revenue story, I mean, it sounds really compelling. Market share gains, new customers, growth across the board.
It really is.
But that brings us back to the profit challenge. That non-GAAP gross margin, 41.4%. You said it was roughly in line, but dipped a bit sequentially. Why?
Management pointed to a couple of things. Product and customer mix shifts, which is common, maybe selling more of slightly lower margin products or to different types of customers in the quarter, and also higher transportation costs.
Which are still a thing, huh?
Apparently so. They have a long-term target for gross margin, around 42-43%. So they're close, but not quite there, and it slipped back slightly.
Is that just ADTRAN, do you think, or is the whole industry feeling that margin pressure?
That's a great question. I think it's likely a bit of both. The telecom equipment space, especially with these big fiber rollouts, it's very competitive. Service providers are pushing hard on pricing.
Right.
So while mix and transport costs are specific to ADTRAN, there's probably a broader industry squeeze happening too. Their non-GAAP operating profit, remember, was $8 million or 3% of revenue. Better than last year because revenue was higher.
But lower than Q1.
Exactly, down from 3.9% in Q1. And operating expenses also went up, mostly due to currency swings, the exchange rate impact, and higher sales commissions from that strong revenue.
So it really raises that question for you, the listener. How well can ADTRAN manage all these moving parts, the internal costs, the external market pressures, to actually hit those margin targets?
Yeah.
Especially if capturing market share means maybe sacrificing a bit of profit margin in the short term?
It's the classic growth versus profitability balancing act.
Definitely. Okay, but let's switch back to the positive side, that cash flow. Management seems very focused here.
Absolutely. That operating cash flow of $32.2 million and free cash flow of $18.3 million, I mean, that's a significant improvement, not just a little bump.
Where did that improvement come from?
A lot of it looks like good old-fashioned operational efficiency. Net working capital improved significantly by nearly $22 million sequentially. Meaning they tied up less cash in things like inventory and accounts receivable. They collected money faster from customers. Days sales outstanding, or DSO, improved to 57 days. That's pretty good for this industry.
And inventory.
Big improvement there, too. Days inventory outstanding, DIO, dropped by 17 days to 135 days. That means they're managing their stock much better, not letting products sit on the shelf for too long.
Less cash tied up, more agile.
Exactly. It makes the company financially healthier.
And they're also looking at their actual physical assets, right?
Yeah.
Selling off some things.
Yeah, they mentioned they're actively trying to sell their Huntsville campus, which they consider non-core now. And they're looking at maybe selling and then leasing back their East Tower building.
Trying to unlock capital, focus the balance sheet.
Precisely. Optimize the assets, focus on the core business. It's also worth noting, they mentioned one customer made up more than 10% of revenue in Q2.
Ah, the concentration risk point. Investors always watch that.
Always. Okay, so shifting gears a bit to the strategic direction. What's the bigger picture here?
Well, the CEO, Tom Stanton, he really emphasized their investments in next-gen network architectures, positioning ADTRAN, he said, to help customers deal with cloud, AI, edge computing, all the big trends.
So not just selling boxes, but enabling these major shifts.
That seems to be the pitch.
Yeah.
And they feel they're gaining market share because of it, partly from new customers, partly from that cross-selling synergy we talked about between the optical and fiber access sides.
Okay, and what are the specific drivers for, say, their optical business? They mentioned AI.
Yeah, several things. Building out private compute infrastructure, the huge expansion needed for AI infrastructure in general, ongoing 5G network densification.
So more cell sites needing fiber backhaul.
Exactly. And just general critical infrastructure upgrades. A highlight they mentioned was launching their new SDX 6400 series platform.
What's special about that?
It's connecting the first commercial 50 gigabit PON customers. In the UK, actually.
50 gig PON. Okay, that's a big jump in speed and capacity over what most people have today. Sort of future-proofing for AI data demands, cloud gaming, all that stuff.
That seems to be the idea. And their Mosaic software suite is kind of the glue holding it all together, right? Integrating everything from the network core out to the customer's house.
And they're adding AI into the software itself?
Apparently so. They said they have live customers deploying new generative and agentic AI applications within Mosaic. The goal: lower operating costs for the network provider and hopefully a better experience for you, the subscriber.
Hardware and intelligent software working together, that's the dream for network operators.
Definitely. Anything else on the management side?
Well, the CFO mentioned they're working on strengthening their foreign exchange, or FX management, trying to build a better hedging strategy to smooth out the bumps from currency fluctuations.
Which makes sense, given over half their revenue is non-US.
Exactly. They want to move towards more constant currency reporting, make things more transparent. Oh, and one small point, remember they pre-announced that Q2 revenue would be higher than expected back in July?
Yeah, I remember that.
Turns out that was actually required under German disclosure rules they inherited from the ADVA merger. If results deviate materially from guidance, they have to announce it quickly. Just a small detail about operating globally.
Interesting complexity. Okay, so with all that context, let's look forward.
Yeah.
What about their guidance, the outlook?
Right. For Q3 2025, they're projecting revenue between $270 million and $280 million.
So continued sequential growth from Q2's $265 million.
Yep. And non-GAAP operating margin, they expect that to be in the range of 3% to 7%. So potentially a nice improvement on the profitability front from Q2's 3%.
That's a pretty wide range, though, 3% to 7%. And that excludes potential tariff impacts, they said.
Correct. Always have to watch those trade policy variables. But generally, management sounded pretty confident about the second half of the year. Continued growth, continued profit improvements.
Driven by.
Strong customer demand, disciplined execution. They even suggested momentum might be strong enough to overcome the typical seasonal slowdown you sometimes see in Q4.
That would be significant if they could pull it off. A strong signal.
Definitely.
Are there any specific sort of new things helping them out, tailwinds?
Yeah, a couple interesting ones. Remember that competitor, BCS, that went bankrupt?
Vaguely, yeah.
Well, ADTRAN said that's already starting to help them win business, especially in the U.S., both on the infrastructure side, the OLTs, and the subscriber gear side.
How much business are we talking?
They estimated it could be around $10 million across the business once it fully rolls out. So that's like a free bonus almost.
An unexpected boost. Anything else?
They're also seeing good traction winning new deals with Tier 2 and Tier 3 carriers in the U.S., the smaller regional guys. Plus, continued strength with the big Tier 1 providers and enterprise customers.
And you mentioned something about data centers earlier.
Yeah, there's a lot of activity around data center interconnect, DCI, connecting massive data centers together, and also these things called MOFN networks. Yeah, it stands for Metro Optical Fiber Network, I think. Basically, local service providers building dedicated fiber networks for the big cloud providers. ADTRAN said they've won some early deals there. It's still early days, but potentially a big growth area.
And the cable companies?
MSOs? Yep, they see opportunities to grow business with the big cable MSOs in the U.S. too. They said they have product approvals in place, which is often the first big hurdle.
Okay, so lots of potential avenues for growth. If you had to boil it down, what are the absolute core drivers for them right now?
Management basically said the number one driver is still upgrading networks for residential broadband. That fundamental shift to fiber, which of course also pulls through sales of their subscriber gear.
Makes sense. And after that?
Optical networking getting back to sort of normal growth levels, plus winning business in these newer applications like 5G densification and those AI-driven bandwidth upgrades we talked about.
So it sounds like they're positioned well strategically, but for you, the investor.
Yeah, the story comes back to margins and cash, doesn't it? Despite the strong top line and the strategic positioning, can they consistently expand those margins? Can they keep generating strong cash flow? That's what's needed to turn that healthy revenue into, durable earnings power that the market really rewards.
Q3 execution against that guidance, especially the margin range, is going to be really key then.
Absolutely. That and hitting more customer deployment milestones, showing that the pipeline is strong. The narrative really has to shift towards demonstrating tangible, consistent progress on the bottom line.
It really is that classic tug of war. The market's reaction, selling off the stock after earnings.
Yeah, quite significantly intraday.
It just screams that, okay, revenue and cash are nice, but show us the profit. Show us the consistent, expanding profit.
It's the show me the money moment, like you said. And it's happening against this backdrop where, yes, service providers are still spending, especially on fiber and optical transport. And yes, AI is driving traffic growth.
Which should be good for companies like ADTRAN.
It should be supportive, absolutely. But it also means competition is fierce. Pricing, product mix, managing costs, that execution becomes absolutely paramount. The tailwinds are there, but so are the headwinds pushing on margins.
So catalysts for the next quarter or two, hitting Q3 numbers, especially that margin guidance. More news on customer wins, deployments, updates on the order book, the pipeline momentum. It's all about showing they can grow efficiently, not just grow.
Yes.
Okay, now let's shift to our This Is Not Financial Advice segment. Just a disclaimer, folks.
Yes.
It's purely for discussion, an idea to think about. Always do your own research. Consult a professional. Don't trade based just on this.
Definitely not. But looking at ADTRAN's situation, that clear revenue beat, strong cash flow, contrasted with the EPS miss and that negative market reaction, it does present an interesting, maybe even slightly outrageous thought.
Go on.
Well, did the market overreact? Did it focus too much on that EPS miss and maybe ignore the strength in demand, the revenue beat that they'd even pre-announced?
So what's the potential play here, just hypothetically?
You could consider maybe a near-term bullish options strategy, something like buying out-of-the-money call options that expire in the next month or two.
Out of the money calls.
Yeah.
Meaning you're betting the stock price will go up reasonably significantly relatively soon.
Exactly. Picking a strike price maybe 10-15% above where the stock settled after that earnings drop.
Okay, what's the rationale? Why take that bet?
You're betting on a quick rebound. Betting that the market will kind of step back, look at the underlying momentum, the broad revenue growth, new customers, the really solid cash generation, which, remember, funds future investment.
Right.
And reevaluate. Plus, that confident Q3 guidance, especially the hint they might beat seasonality, maybe suggests a floor under the stock price. And don't forget that $10 million potential boost from the competitor bankruptcy.
A little extra kicker the market might not be fully pricing in yet.
Could be. So the idea is that the sell-off was maybe an overreaction, creating a potentially cheap entry point for a short-term bounce as focus shifts back to the top-line strength and those future drivers like AI and 5G.
The outrageous part being, what? Ignoring the current margin squeeze?
Sort of, yeah. Or at least betting that the positive revenue and growth story will outweigh the margin concerns in the near term. It's a conviction play that the initial hit was too hard based on perceived fundamental undervaluation, even with the profit questions. Betting the longer-term story wins out over short-term disappointment.
Interesting angle. Definitely something to mull over. Again, not advice. Okay, let's recap the whole picture.
ADTRAN delivered a strong top-line Q2. Impressive revenue growth, healthy cash generation, driven by market share gains, good strategic positioning in fiber and optical.
But profitability is still thin.
Yeah.
And the market is laser focused on seeing sustained margin expansion.
Management's Q3 guidance and their commentary, though, they do point to continued momentum. They see a path to better profitability, helped by those big trends like AI, cloud, 5G. The foundation seems solid.
But execution on the bottom line is everything right now.
It really is.
So the critical question we leave you, the listener, with is this. How quickly can ADTRAN actually translate that impressive revenue growth, that strategic portfolio, into the kind of consistently improving profitability, the robust earnings power that the market really wants to see? When does the potential turn into proven profit?
That wraps up our deep dive into ADTRAN's Q2 2025 earnings.
Thanks for joining us. As always, we encourage you to dig deeper into the company's prospects yourself.